So here's the trade page explained, and again you see in this scenario we're collecting $70, which means we're risking $130 on this trade. And how did I get that? Well, our verticals are $2 wide, both the put and the call vertical. And remember, only one of these can be a full loser at any given time, because if the stock goes all the way down, this call vertical is a winner and this put vertical is a loser, and vice versa. If it goes all the way up, this put vertical is a winner and this is a loser. So we can only lose on one side at any given time, and that's why it's a $2 width total on the whole trade. Even though we have two $2 wide verticals, only one can be a loser. So if we collect $70, we can lose 130 because the width of our strikes is $2, which means the total amount of this trade, if you add up the profits, max profit and max loss, has to equal the width of the strikes, and it does, $200. 70 is our max potential profit, so 130 is our max potential loss. So let's take a look at that shorthand POP formula now and see how that would work out. Because not everybody's going to have access to this software, but you still want to be able to work out, these numbers when you set these things up. So what was our formula? Well, remember, it was the max potential risk, right, which is 130, divided by the width of the strikes, multiplied by 100 to give us the POP percentage, or our shorthand version of probability of profit. And if you do this right here, you end up at 65%. Well, remember the software says 66, so not bad, right? The shorthand formula is pretty good. All we do is we take our max potential loss divided by the width of our strikes, which is $2 down here, multiply it by 100 to turn it into a percentage, and there you go. Our shorthand formula works out pretty darn well. And it shows us we have a roughly 65% POP, roughly 65% chance of making at least $1 on this trade. And now the final piece to the puzzle of trading. Remember I said on these particular Iron Condors we're looking to manage anywhere from 25 to 50%. So what does that mean? Well, if our max potential profit is $70, what would be 50% of that? Well, that would be $35, right? And if we wanted to do 25%, obviously we're going to get into some fractions, but you can work it out yourself. 25% of that is just going to be $17.50. So let's just use 50% as our managing winner scenario. So if we were to manage this Iron Condor at 50%, how would we close this trade when the time came? Well, if we're selling it for 70 and we're looking to make a $35 profit, that would mean we're going to close this trade when we can buy it back for $35, which on your platform will show up as 35 cents. Because remember, we sold this originally for 70 cents or $70. Options are times 100. So that's how managing winners works. If we sell it for 70 and we're looking for a 50% winner, we're looking to close this trade and we can buy it back for 35. It's that simple. 25% would obviously be a different number, like I said, 1750. But that's managing winners. And these are the same kind of tools we're going to use for all of our Iron Condors. You have to know how to manage a winner and what that means. So this is what managing at 50% means. If the most we can make is 70, then 50% of that is 35. That's where we're going to close this Iron Condor, because that's going to give us the best results over time. So there we go. Managing winners, successful. We're going to manage it roughly 50%, in this case 25 to 50. Everything fits our rules like I mentioned. 46 days to expiration, $2 width. We collected the right amount of credit. That is a 1/3 width of the strike Iron Condor setup, and that's how you do it.